Hey everybody, Signet here with the Bullish Bears. I'm going to do this video on a price action pattern uh, based on futures products, but honestly this pattern works in just about any market conditions. And the reason I'm focusing it more on the futures is one, I use it constantly in the futures, but two, the futures are uh, almost a 24-hour a day product. They close, at 2 hours and then they're open again. So it makes the pattern more, I don't know, reliable, I guess. There's not as much break in it. The other thing that is worth mentioning is we've been in a bull market since 2010, and while there have been pullbacks, the main idea here is we're looking for a reversal from a broken bear flag. Now, a bear flag is a continuation pattern. So we would be looking at something that is trending to the downside, pulling back into a flag, and then continuing on. That's the idea behind the flag. But instead of having this bear flag continue, we would be looking for the bear flag to fail, and then we would trade the reversal. At some point, we will no longer be in a strong bull market, and this will not be as reliable. If we get into market conditions where we are struggling and you hear a lot in the media that we're no longer in a bull market, you'll know when the time comes because we've been in a bull market since 2010. Here we are in 2020. We have been in this bull market forever. When it ends, you will know. You won't have to guess or try to figure out on your own if we are no longer in a bull market. So until that time comes, our edge is not trading this pattern from the top side, which you can do, but rather trading it from the bottom side. So instead of trying to even hunt for a failed bull flag and trading that reversal, we are strictly talking about trading the failed bear flag. When the time comes, I will do a video on the bull flag, and of course you could take everything from this video and just apply it to the top side failure, and you could very easily trade that side of the pattern. I'm not going to say that even in this strong bull market that you could not find the setup, because you absolutely can. The idea is that you can more often find this bear flag failure. And in fact, just this week, and I'm recording this on Valentine's Day, but just this week I traded the pattern successfully 4 times for over 40 ticks. I started the trade with 2 contracts at least, and after closing out the trade with profits with 1 contract, I kept the other one on for over 40 ticks. Now I know that might not sound, relatively exciting. 40 ticks might not seem like very much to some of you out there, but I was easily able to hit those 40 points, and I traded a lot more than that this week, but I did have 4 that got more than 40 ticks. So let's get into this a little bit. It's been called a basing pattern. It's also a reciprocating pattern. It is most definitely a reversal pattern. So you could argue the fact that it might not be, quote, a basing pattern. The idea that it's a reciprocating pattern has been argued a little bit, but it is absolutely a reversal. So in this failed bear flag, it's very simple. It is very easy to see. Once you see it, you're always going to see it. The structure is very, very easy, and it works on all time frames. When I say it works on all time frames, we have to add a little asterisk here. It is commonly known but new traders might not grasp this, that when you get into the very low time frames on a candle chart, you cannot give a lot of respect or trust to candle patterns. They will fail more in the lower time frames than they fail anywhere else. That's not just for candle patterns, that's for support and resistance, momentum, trend, channels, bull flags, bear flags, you name it, whatever it is, on the smallest time frames, they are the weakest. And the higher out you go, the more respect, the more trust that you can give to patterns and setups and support and resistance. So having said that, if you attempt this on 1 minute, 2 minute, 3 minute charts and you find that you're failing often, maybe think about stepping back a little bit. I typically use it on a 15-minute time frame. I'm reasonably decent and comfortable trading it on a 30-minute time frame. I rarely trade it on a 5-minute time frame, and I never trade it less than 5. So let's take a look at the pattern first. What you see here on my chart is a 15-minute S&P 500 futures chart. I am going to apply this to the futures through this video, but you can do this in other markets. The first thing you need to do is identify a trend. You do not want to apply this to a market that is not trending. This is very important for you to understand and to recognize. We are trading a reversal pattern, and if a market is not trending, then it's not going to reverse because it is not changing direction, right? You can see that I have on this chart a 50-period moving average. That's the orange moving average here. I like having the 50 on there. I don't really need it. It's just something that I like having on my chart all the time. It is always on there. I like having it on there. Sometimes I add the 200, maybe the 250 instead of the 200. But I always have the 50. It's just my go-to. And when you focus more on the futures on a day-to-day basis, if you stay in the higher time frames like a 15-minute or a 30-minute, you're going to find all kinds of trade opportunities, good, clean, strong trade opportunities that you can rely on and depend on again and again and again. So that's why I leave it up there. I might not be trading off of it just because the moving average comes into contact with price action, but that is there. The other indicator that you see is this line, and that is exactly where price is at. That is a dynamic moving line. When price ticks up, the entire line ticks up. When price goes down, the entire line goes down. One reason that I like it is I can look right and I can see where we're at. Where is price? The other reason I like it is I can look left. One of the things that I'm always looking at is, are we about to hit a pivot in any previous price action? And by pivot, I mean a place where price was moving in one direction and then it turned around and began moving in a different direction. Price pivoted. Identifying when price is getting ready to hit one of those areas is something that I look for all the time. I'm always looking to identify when we're about to hit that. So having that dynamic price line on my chart is something that I like to do. It saves me from drawing a line to the left all the time. The reason that you see red, green, and cyan dots is also because this is the TTM squeeze without the histogram. So normally you would see histogram bars moving up or down, and it would be in the lower portion of the chart. One, I don't want to put something in the lower portion of my chart. Two, I don't need the histogram bars. I would rather just have the dots. Now, a lot of people confuse the idea of a squeeze with market compression. Just because you see candles consolidating does not indicate that we're in a squeeze. A squeeze has to do with volatility. The Bollinger Band is a volatility indicator, and when you see the Bollinger Band constricting, that is indicating to you that volatility is constricting. We call it a squeeze when the Bollinger Band gets inside of the Keltner channel. Now, I definitely don't want a Bollinger Band and a Keltner channel on my chart. All I want to see out of this is if there is some form of volatility compression. I am not reacting to, quote, a squeeze. The green indicates that the squeeze is projecting a bullish move. Red is projecting a bearish move, and cyan is just projecting the fact that we are squeezing. I don't care what color is showing, just recognizing that volatility is compressed is good enough for me. It is something that I glance at, kind of like looking out the window to see if it's raining or sunny or cloudy. I'm just glancing at it. I don't take any signal from it in a bias of any way to go up or to go down or to take a trade at all. It is just something to glance at to get a feel for what kind of volatility we have in the market at that particular time. That's it. All right, so now that we've got all of that out of the way, let's find the pattern and take a look at it. We need to identify a market that is trending. Now, there's been a lot of discussion about being able to identify trend. You can get indicators that can help you find trend, and there's quite a few that we could go through in the list. Most of those were built back in the days when people didn't have computers readily available. Maybe they would have one at work, maybe, but they definitely didn't have one at home unless they were really, really rich. All right, so most people, when the indicators were built, like the ADX and others, they were at work messing with a computer, or they were drawing these out on hand, drawing their charts out, and they weren't quite sure if they were building them to scale. Right? So we take this for granted now in this day and age, but if I zoom in a little bit, you can see the story being told in the candles, how they're different sizes. The wick is up there and there's no wick on the bottom. We can identify when there's inside days or compression, and we got thrusting candles. All of this, step back 50 years into the 1970s and imagine trying to draw this candle chart out and making sure that you got the wick appropriately sized and scaled to match the chart. And if you're working with other people, you had to hope that the other person knew what the heck they were doing and they didn't get anything wrong along the way. And so if you had an indicator that could identify trend for you, you could kind of relax a little bit, because that would be helping you out. You wouldn't just have to look at the candles. You could look at that indicator and you could say the math tells me we're trending. So thank goodness I have that ADX calculation that helps me identify that we're trending. Those days are gone, guys. You don't need an indicator to tell you that you're trending, because we're not drawing these out by hand. There's no mistake worrying about scale and size. Okay? So how do you identify a trend? You could bring your 5-year-old into the room and put this on the chart, on the screen, and ask them if it's going up or going down. If that child can answer you in 3 to 5 seconds or less, it's trending. If they pause or hesitate or seem uncertain at all, we're not trending. So imagine that. A 5-year-old can tell if this is going up, if it's going down, or if they're not sure. And if you're not sure, it's not trending. If that confuses you at all, you can turn the candles off and turn it into lines. So if we go up here, we go to candle and change that to line, you can very easily look at that line and ask the question, is that line moving up? Is that line moving down? If the answer doesn't come out to be yes in either of those, it's not trending. So we want to identify a trending market. That is the first step. by the way, that trend identification will work on all time frames. If you're on the weekly, is it trending? Yes. If you're on the daily, yes. 2 hour, no. See how easy that was? Are we trending? Yes, no. If you can't identify it in seconds, we're not trending. So first we identify the trend. The trade that we're looking at is a failed bear flag. So we will not be trading this from the top looking for a bearish move in the market. We will only be trading this looking for a bullish move in the market. Once the trend has been identified, we're looking for the low. Now the thing about looking for a low is, how do you know that it's the low? Right? We could be fair with this and we could say, look, price was trending to the downside and it set a low and then it started to pull back. Well, how do I know that's the low? Well, we don't yet. We need to wait for verification that that is the low. And you could see that where it had set a low here, as price moved on, it pulled back to Fibonacci, made its next leg down. This was no longer the low, and we had a new low. And we were still trending. So I zoomed into this part of the chart for a reason. This is the pattern right here. From start to finish, the entire thing. Now the reason it's called a reciprocating pattern is because we want to get what we give. We expect this to go back to where it started, like a big circle, half a circle. So you already have a target in mind where you're getting out of the trade. That's one of the wonderful pieces to this trade logic here. A lot of times we get into a trade, especially newer traders, and we don't quite know where to be getting out. We don't even know where we should start to be getting out. But in this trade, we're looking for reciprocation. We're looking to get out where it started. So you know before you get in where you're looking to get out. And you don't have to get completely out there. You could just get most of the way out and leave a runner on and see how far you get. So here on the left side, we had a market trending to the downside. And it set a low. And after it set a low, we put it on watch because we are looking for that to be proven as the low. Price begins to range sideways, breaks the 50. And by the way, that is a great indication that a downtrend is done. Now, you're going to see this pattern fulfill itself many times without first having tested and broken and failed the 50. So this isn't a requirement for the pattern, but it is one way that I like to use to verify that a trend is dead. Now, when a trend is dead, that does not mean that a reversal is coming. This could be downward trending. It could stop trending and range sideways and break through the 50 and do all of this mess and then continue to go down more. So just because a trend has ended does not mean it cannot begin trending in the same direction without ever having reversed. So we've got the trend completely identified. We've got the basing pattern. This is building a base. One thing that you should notice here is that if it was going to work out as a bear flag, we would be looking for the move lower, right? And we would most likely use the pole as our leg to go down to that next level, right? So I've had people ask me, how do I know for sure that this bear flag isn't going to continue. How do I know it's going to fail? I don't. You don't. There's no one thing that I could point to with certainty and say, oh, of course I knew it was going to fail. We don't have anything like that in the marketplace. There is no 100% anything in the market. So we need verification that this trade has triggered and that we're ready to go. Now, one of the things that you can do is you can wait for confirmation. We already know where our target is. We do not have to get in as soon as price breaks above this pivot. We can wait to make sure the price is strongly moving back in the direction that we anticipate it's going to go, and we could get in anywhere in here and get some profit. Now, I'm a very firm believer in jumping onto something that's already moving, getting a little bit of the ride, and getting right back out again. I don't care to get in at the bottom. I've done it on accident a few times, but every time I've ever tried to do it on purpose, it never quite seems to work out. And I most certainly don't care about riding it to the top because A, how do you know it's the top until it starts to pull back, right? And B, I don't want to get tangled up into anything that could happen along the way and lose my profits. So if I can get in after it started to move in the direction I thought it would go, and I get out before it gets to where I think it's going to stop, then I can avoid trying to get in at the lows and failing, and I can avoid having a market that fails to get back to the top and then comes back and stops me out along the way or takes some of my profits away. Now, this isn't always going to work, but it will help you keep your profits a lot more often if you can just try to avoid the greed and the chaos, right? You can see here in this pattern, I've got a pretty decent move here, 32.65 to 32.80. That's 15 points. Now I could take that with 2 or 3 contracts and I've got a really decent trade. That's not bad, right? Not bad at all. I could even get out 2 contracts and leave the third one on for a runner and just see how if I could make it all the way back to the top or not. Not bad at all. I'll take it. So you are now looking at the entire pattern for this trade. Identify the trend. Identify the low. Verify the bear failure. Take a trade somewhere in the middle. I really like this pattern. I can't express to you how much I enjoy trading this. Now, I made a video similar to this last week because I was answering some people's emails, and they were asking me for one specific pattern, since I continue to tell people that if you're new to trading, you should find one pattern that's continuation and one pattern that's reversal. And if you would just study one of those each, you would have a trade strategy that would get you a trade almost every single day, because you should always be able to find a range-bound market. And then if you're even remotely diligent, you should be able to find something that's trending in a day. Now, if you're like me and you trade futures, as a day trader, that's the only thing that I trade. I save options trading for swing. But when I'm day trading, if the futures aren't trending, then they're just not trending, right? So I'm either going to get a trend trade or I'm not. Well, if I'm not going to get a trend trade, then I don't have a continuation, and that means I need to find a reversal trade, and that means I need to find a reversal pattern. This is one of those reversal patterns, right? Another one would be trading down here, just trading this. Reversal, 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 reversal. There's nothing wrong with that. There is absolutely nothing wrong with that at all. I don't mind trading that. But the failed bear flag is a more profitable trade, in my opinion. It is not a home run, but definitely a third base hit. And it saves me commissions because I'm not just sitting at the computer all day trading this whip back and forth with all of these opportunities for failure along the way. I'd rather just avoid all that. So, in the emails that I would have received last weekend, somebody was asking, "Look, can you just give me a pattern?" So I pointed out this one, made a video, and all this week I presented it to the Bullish Bears community. We took multiple trades in this pattern setup, and by the end of the week, everybody in the community was asking, please just make a video on it. So here we are. You now have one reversal pattern. It is not the only reversal pattern out there. It's not even the best one out there. But it is a good pattern. There's nothing wrong with only having one to start with so that you at least have something that is profitable right now that can help you grow your account and grow your skills while you continue to go and learn something new. But master this. Master one. It doesn't even matter which one. Master a reversal pattern. And what I mean by mastering this pattern is I don't mean watch this video and then just go do it. Spend weeks on it. Spend months on it. Check it on multiple time frames. Check it on multiple markets. Look at this and repeat this and use the hard right edge on this so much that you see it in your sleep, that you talk about it, that everywhere you look, you identify it. And start to recognize ways that you can identify when it is not going to work. And different ways that you can identify where your stop might be if you're a person who uses stops. Where you could scale in when you're not quite sure. How you could scale out and let that runner go to get back up to the top. Learn about what I have coined the Busby. And I really don't know what else to call it. And I'm almost positive that it's not called a Busby. But what I have termed the Busby is when price gets to an area of resistance and it comes back and it hits that area of resistance again and then it finally breaks out. More often than not, after the breakout, price will come back down and it will validate what was resistance and is now support. And with that validation as the new support, it will then begin to move on in its way. Okay, this doesn't always happen. Here's a great example. It didn't happen here. It also sometimes fails, as it did right here where I'm drawing this. It did the Busby. It broke out, but when it came back to validate the range, it broke right through the range and fell right back down again. All right, so you can't rely on the Busby to always come through. Sometimes there won't be a Busby at all. You have to decide for yourself how you're going to verify this pattern. One of the things that I recommend when you're looking to verify this pattern is the fact that you do not need to get in anywhere in here. You can, but you do not need to. You definitely don't want to try to get in down here. Don't get greedy. This pattern can pay you very well, very often. Don't get greedy. There's no reason to get in down here. You can. I'm not saying that it won't work. And you could even, get profit here. Get in, get out. Get in, get out. And get in again and ride it all the way up. Absolutely. But come on. Don't get greedy. Every one of those trades down here would be an opportunity for failure, right? We don't know that this is going to be the low again. We don't know that that's going to hold. We don't know that the breakout here fails, right? So if this is the pattern that I'm looking for, and the target to get out of the trade is way up here, then there is absolutely no reason for me to risk getting in anywhere down here, right? I've got my target. If we look at this target and we say that 32.90 is going to be where we want to exit this position completely, we could leave our runner on back up to the top, but we would not anticipate leaving our runner on past 3290. So let's write that down for a moment. 3290. If that's our target, how many points do we need to make this trade worth our while? Right? Is the juice worth the squeeze? So as the pattern developed and it was resolving this base, it built this pivot right there. Now we've got something that helps us with this problem. When to get in? Where is our stop going to be? How much risk do we have in this trade? I'm willing to use some round numbers, so we'll say 32.55, and I'm going to just move this blue line to 32.55, and that is going to be this portion of the pattern down here. And I'm going to get rid of that box because we don't need it. So if 32.55 is the top of this resolution, and here 32.65 is our verification that the trend is ready to reciprocate, then from 32.65 to 32.90 is my target. Anywhere in here would be a great place to take a trade, right? Because if it made it this far up and everything's looking really good, then I am fully confident that this trend is intact. And we know it can fail, right? We do. There's no 100% anything. But I'm very confident in a trade that has made it this far up. Now, you might be looking at this and saying, there's no way that I wouldn't be getting in somewhere down here, right? And hey, I get it. But after you have a few of these fail in this lower section from trying to trade it all the way back up, you're going to decide that you're going to want a little more confirmation. And also, trust me when I tell you that after a year or 2 years or 3 years, you're going to get really good at getting in at these lows and managing your risk and being able to get in before we even get past that 32.55. Oh yeah, it's possible. Today, as a matter of fact, I took 2 trades off the lows. Now, I'll walk you through how I got to one of those lows, and it's because I averaged into that low. Those words, if you're even a little bit experienced, should get your attention, right? I averaged down into the lows. That means I tried to get in before confirmation and started to take heat when it turned against me. If you attempt this trade from these lows, you are going to take that kind of heat when it fails against you. And then you're stuck trying to figure out if you want to eat that loss or add more risk into the trade. And it's just not a good situation to be in. So if you wait for it to break this lower section and you decide that's good enough, that good strong thrusting candle right there, I'm good enough. I'm going to get in somewhere in the middle of that strong thrust. You could, but recognize that, hey, this candle was also a very strong thrusting candle, and it failed, right? So good strong move in price, and it came right back down again, and then this candle tried it. So you could get in the middle of all of that. Absolutely, you could. How you resolve this is going to have to fit your comfort level. It's going to have to fit your skill level and your account size. There is nobody who can give you this answer. I don't know how much you're willing to risk. I don't know what kind of risk taker you are. I don't know how big your account is. I don't know if you want to get in with one contract or 5 contracts or 50 contracts. I don't know. You do. I'm very comfortable with taking up to 3 contracts in my futures trade. Whenever I am in doubt of a pattern's success, I will start with 1 contract, especially if I'm getting in at a place where I could take failure in price action temporarily. So suppose price gets up here, this immediate candle with the wick, and I pull the trigger, and then I take heat. Now that's 32.65, and that's a 10-point drop right back down. And suppose on the way down, I'm already looking at this situation. I'm anticipating some help here at the lows. So I pull the trigger and I add into my position somewhere along the way. Because I don't know that we're coming all the way back down, right? I just got a pretty good hunch when it starts to fail that that's where we're headed. And then I average in another one. And I take one at the lows. And now I'm 3 long. And in the next candle, this green candle here, it starts to pop right back up again. Now, me personally, when I do average down like this, if I didn't start with 3, I'm more often likely to get out of at least one of those 3 on the way back up, because it could get back up here again, and then it could just come right back down and fail on me, right? And if it does, I want to be able to average in again, and I'm not wanting to do that more than 3 contracts. So as we work our way back up, more than likely I'm going to get out of at least one of these 3. And once we break above and we start to move up, now I'm looking to get risk out of the trade. At that point, somewhere in here, I'm long 2 contracts. And I want my profits. Now, 65 was our original starting point. I'd be happy getting 10 points out because I've already got my target up here. So after 10, maybe 12 points, I'd get one of those 2 contracts out and I would leave the other one on back up to the top. And this is not a hypothetical. I traded this 4 times this week with pictures and recordings showing exactly how I trade this. So it is what I do. When you're more sure of the pattern, when it hadn't already failed 3 different times, you could trade this completely different. When you get a Busby, your confidence in the trade becomes completely different. Okay? All of those things are going to be something that you need to work out as a part of your side of this. What I got here for you is the bones of a trading strategy. But it is not a gift-wrapped package. The work is not done. And now the burden and the obligation is yours. You need to complete the rest of this. And that means you need to determine how many contracts you're willing to trade total, how you're going to get in, how you're going to get out, what your verification is. What if there is a Busby? What does that look like? What if it fails? Where are we getting risk? How much are we willing to lose? Where would a stop be? Now, I don't trade with stops. What I use is, okay, it's a disaster stop, but that stop is not to limit my risk in any one trade. It is more to protect my account from a tweet. So let's look at this pattern somewhere else where it had a Busby. One thing I like about this is that it is common and is easy to find. So here we had another one. I had the trend down. We verified the lows. We verified structure. It gave us a Busby, yeah, to a point, but you can see it failed to make it back up, at least as the pattern should have been. It did eventually get there, but I would call this failure, right? This is where we're trying to go, and it got there the next day at the open. I would consider that failure. But let's walk it through. If this is the structure, here's our break in price, and there is our Busby that it came back down, validated the lows, and then continued on in the trade. If you had traded that after the verification right there, then you would have gotten some profits in this trade. And depending on your risk management, you might have kept some too. See if we can find something a little bit better. This is not a Busby. This is not the basing pattern. There was no trend here, right? We're just ranging. This is a good strong trend, but that's a bullish trend. So let's back up and see if we can find another setup. This would be a really great example of a bear flag. All right, so there's the pole, there's the flag, there's the continuation down. Good strong trend. From the trend, we set the low, identify that it has failed, and we take the trade. I would argue that we had a Busby. It was really, really late, but we did get one. It struggled with resistance, finally broke above it, came back down to verify, and continued to move on all the way back up to the top of the structure. I traded that this week, by the way. I also traded today's. Now, granted, this is not a trend on the 15-minute. I did see this on the 5-minute, and I did get in, and 33.71 was my entry after I had averaged down. And I got risk out somewhere in here, held on to the other contract, looking to get back up to here, held it all the way back down again. We actually got stopped out in the room here because I had a disaster stop in place down here. And then we just traded it again, got right back in, and got out at the end of the day up here, right before the close. So, out of the 4 that I traded this week that were plus 40 ticks, this was not one of them. I did get profit, but it wasn't 40 ticks of profit. So let's scroll along and find one that has a Busby so I can show you what that looks like. That one looks like it has a Busby. So there's the trend. Sets the low. It sets the base. Breaks out. Comes back to validate. Makes its way. Now, again, does not get back up to there. So the reciprocation failed. Sure, it got there the next day, but I call that failure, right? But that is the Busby. It's when the market comes back down After struggling to break through some resistance, it finally breaks through, comes back down to validate the new support, and then continues to move on its way. This pattern, you will find it more and more and more. Now that you see it, you're going to have a hard time unseeing it now that you've seen it. So here we are again. Strong trend to the downside, set the low. We built the base. Price struggled with resistance, finally broke through, validated the range, reciprocated back up to the top. I'm telling you guys, this is a successful pattern. Get familiar with it. Use the hard right edge. Use whatever metrics you want to use to trade this pattern. Make it comfortable for you. Now, I trade price action, and that means I do not trade with indicators. No RSI, no MACD, no stochastics, no ADX, no ATR, nothing. What you see on my chart, that's what I got. That's what I use. The only thing that I would add to this that we haven't yet discussed is this. At all times on another monitor, I keep this up. This is a 4-part grid of the futures market, and they do move in tandem, a lot of times in sync. The hot pink lines that you see is the previous day's high and the previous day's low. The tan line that you see is the Globex open. It's when the market opened back up at 5 o'clock after having closed for settlement. That's it. So I will watch this on the separate monitor throughout the day. It's how I keep track of the market. And it's the only thing that we had not yet discussed. If you are an indicator person, that's fine. Own it. Put the indicator on. Find this pattern and use the hard right edge. If that term is unfamiliar to you, let me demonstrate what that is. And we're going to move this into a smaller time frame. How many days do I got on there? 15 days, 30 days. So here's a 5-day. Here's a 5-day, 5-minute. And we'll just use this one right here. Why not? Well, all right. We'll add more time. So there's the lows. There's the pivot that needs resolved. There's our trend. It's there, but it's also here. There's the trend. And we're trading the resolution. Right? The hard right edge would be after we've identified the trade, we stretch the chart out. We roll it to the right until we can't see the candles anymore. Now, we already know that this one works, right? We're not trying to act surprised like, oh, yeah, I didn't know that's where. Of course, we know. The point is trying to answer the question, if you're using an indicator, what happens when price gets to that point that you're looking for? What is your indicator telling you? What signal is it? Is it a MACD crossover? Is the crossover on the MACD lines, or is it crossing over from underneath zero? If it's an RSI, what signal are you looking for? What time period are you using? Is that an RSI 8, an RSI 10, an RSI 14 period? What about the stochastics? Whatever it is that you use, roll the hard right edge. When the trigger finally came and you got in, what would the signal be on your indicator? How reliable is that? Does it let you down? Does it show up late? How are you going to resolve that? Those are the kind of questions you're going to have to answer, because I don't trade with an indicator, so I really can't give you anything that's going to help you out on that one. All right? So hopefully you're starting to see, even now while I'm just scrolling through here, you're starting to see that pattern more and more often. And that's a good thing. That's what we want you to see. We want you to see that pattern. We want you to have a resolution to that pattern. How are you going to trade it? Because now that you've seen it, and you've watched this video, you're going to see it all the time. And the answer now is, what are you going to do about it? What are you going to do with this newfound opportunity that you've got? Good strong trend right there. And we verify the low because it doesn't come back. And we verify some resistance and we get a break above it. And then we verify the Busby. And then price breaks above the Busby. Did we get a trade anywhere in all of that junk? Yeah, perhaps. This is an ugly mess, right? But when is it ever perfect and clean? When is it ever that great? Strong trend to the downside. Got the low. We've got structure. We get the breakout. We get a little bit of Busby, right? Doesn't make it all the way back down. And we get the run back up. Was there enough room to get profit in there? Okay. Work it out, guys. I can't give you anything more for this, but I don't think you need anything more for this. Don't overcomplicate it. So that's it. The basing pattern, or the failed bear flag. There's the pattern. There's the strategy. I look forward to seeing you at the next video.